Okay, so let's jump right in. Today, we are doing a real deep dive into a pretty complex financial structure.
It's definitely a mouthful.
It is. We're talking about the growth opportunities, Feeder SA, SICAV-RAIF, all coming out of Luxembourg.
And it sounds like something from a grad-level finance textbook, and, in some ways it is, but really understanding the string of letters is key if you're tracking how sophisticated capital moves across borders.
Especially in private markets?
Exactly. I mean, Luxembourg didn't just stumble into being the top European hub for these kinds of investments. This structure is a piece of very deliberate, very clever legal engineering.
So our mission today for you is to pull this thing apart. We want to demystify it. We need to get at why the big players, the institutional allocators, are using this exact setup.
And how it actually works, what each bit of that long name does.
Right. And how it lives up to its big claim of being incredibly fast to market, because it's essentially a shortcut, isn't it? A way to access those high-growth private assets.
Yeah, it is. It's an optimization tool. It's all about deploying large amounts of capital very quickly and very efficiently, and getting around a lot of the usual hurdles you'd see in setting up a fund.
Okay, so let's start with the absolute basics, the foundation. If this thing were a custom-built machine, what are the main legal components that are bolted together to make it work?
It's really supported by three distinct but interconnected legal pillars. The first, and this is probably the most important for its speed, is the RAIF law.
RAIF, so Reserved Alternative Investment Fund.
That's the one. It's the regulatory framework that says, okay, who can invest, what rules does the fund follow, and critically, it mandates that it has to be linked to an external manager.
So the RAIF law gives the fund its basic identity and rule book. What about its corporate shape, the SA part?
That's your second pillar, company law. The structure takes the form of a société anonyme, or SA, which is just Luxembourg's version of a public limited liability company. It's a very standard, globally recognized corporate vehicle.
And its main job here is?
Liability shielding. Simple as that. It makes it crystal clear to investors that their risk is limited to the capital they've put in. Nothing more.
That makes perfect sense. Investors need that certainty, especially when they're pooling capital from all over the world. So that leaves the third pillar, the SICAV bit, and the AIFMD connection.
Right. The third pillar is what gives it its operational flexibility. You mentioned SICAV, that stands for Société d'Investissement à Capital Variable, a variable capital investment company.
And variable capital is important because?
Because it lets the fund's capital go up or down without all the formal legal hassle of issuing or canceling shares that a normal company would face. When new investors subscribe, the capital expands. If they redeem, it shrinks. It's pure administrative ease.
I see. So SA gives it the corporate shield, RAIF gives it the regulatory speed, and SICAV makes it easy for investors to actually move their money in and out.
You've got it. And overarching all of that is the mandatory link to the AIFMD, the Alternative Investment Fund Managers Directive. That ensures the manager running the fund is held to very strict European standards for governance and risk.
It's quite a combination. A mix of stability, flexibility, and, as we said, speed.
A potent mix.
Yeah, let's talk about that speed. The sources we looked at say this vehicle can go from an idea to being fully launched in about 30 to 40 days.
Yeah.
In the institutional world, that is. That's lightning fast. Months, usually. How on earth did they do that?
This is the real magic of the RAF framework.
Yeah.
It was brought in back in 2016 specifically for this reason. The time saver is one single brilliant decision. They removed the need for prior approval by the CSSF, that's Luxembourg's main financial regulator, at the fund level.
So you just get to skip the regulatory queue for the vehicle itself. That sounds risky. What's the trade-off?
That is the crucial question. And the answer is they didn't really sacrifice rigor. They just shifted where it's applied. They traded direct fund supervision for mandatory indirect supervision.
Okay, what does that mean in practice?
Think of it like a new high-end apartment building. The building itself, the RAF, doesn't need a final government inspection before people move in. But, and this is the key, every single critical service provider inside, the management company, the security, the custodians holding the assets, they all have to be fully licensed, fully regulated, and independently audited from day one.
That's a great analogy. So the supervision is on the people, not the paperwork.
Exactly.
Yeah.
Appointing a fully licensed external AIFM is non-negotiable. And that AIFM is the entity that's directly regulated and supervised under AIFMD. The regulatory burden is on the manager, not the fund.
And are there other mandatory safeguards built in
Mm.
to keep that institutional credibility?
Oh, absolutely. The governance structure is rock solid. You have four main pillars of oversight. First, that external AIFM doing the day-to-day portfolio and risk management.
Okay.
Second, you must have a qualified depository bank. Their job is to safeguard the assets, verify ownership, and monitor all the cash flows. It's a huge check and balance.
And what about the financials?
That's pillar 3. An independent external auditor has to sign off on the annual financial statements. And finally, you have the board of directors of the SA itself providing that top-level strategic oversight. So those guardrails are all in place before it even launches. That's why people trust the timeline.
All right, let's shift gears a little. Let's talk about who this is actually built for. We're in segment 2 now, the investment focus. I mean, given the complexity and the minimums, this is obviously not for the general public.
Not even close. We are talking strictly about well-informed and professional investors. They have to meet the specific RAIF qualification criteria, which basically means they're sophisticated enough to understand the risks involved here.
And the entry ticket is pretty steep, I imagine.
The standard minimum is usually around EUR $125,000 DEFTR. There are some exemptions, but that figure alone filters out almost all retail participation.
So who are these investors then? What kind of profiles do we see using this?
It's a really interesting mix. You have your big institutional allocators, pension funds, insurance companies, but we also see a huge number of single and multifamily offices using it.
To consolidate their private market bets.
Exactly. And also sophisticated entrepreneurs, people who've just had a big liquidity event, like selling a company, and they need to deploy that capital into a structured institutional-grade environment very quickly.
That makes a ton of sense. You get institutional access without building the whole institution yourself. So what are they targeting? What kind of growth opportunities does this feeder plug into?
It's incredibly versatile. We see it a lot in growth equity. You know, that sweet spot where a company is scaling up fast but isn't quite ready to IPO.
Yeah.
It's also perfect for specialized venture and technology strategies, especially for scale-ups that already have revenue and need capital fast to win a market.
Is it all just equity plays?
Not at all. It's really well suited for things like private credit and hybrid instruments, and we see it used a lot for co-investment programs.
So like a group of family offices can band together and invest right alongside a big private equity firm.
Precisely. They get access to deals and terms they could never get on their own.
The source material mentions some really specific sectors: health tech, fintech, climate tech. These are high growth, but also pretty high risk. What kind of returns are they aiming for?
Well, the returns have to justify the illiquidity and the risk, right? So depending on the strategy, the targeted IRRs, the internal rates of return, can be anywhere from, say, 8% on the lower risk private credit side, all the way up to over 20% for the more aggressive venture equity deals.
To handle that kind of variety, the structure itself must be really adaptable.
Flexibility is everything. And this is where the umbrella structure comes in, with its multiple compartments. That's a massive feature.
Explain what that means in practice.
It means the assets and liabilities of one strategy, let's say a climate tech fund in compartment A, are legally ring-fenced, totally separate, from the assets of another strategy in compartment B, like a B2B SaaS fund.
So a blow-up in one compartment can infect the others.
Exactly. It protects investors and lets one fund house multiple strategies. Plus, you can set it up as open or closed-ended. You can do currency hedging. It's incredibly configurable.
Okay, moving into our third segment, let's really focus on the business case here,
Yeah.
the operational side. It seems the big benefit is just access and efficiency.
That's a huge part of it. An investor gets entry into a top-tier institutional strategy through one single point in Luxembourg. The simplification is immense.
How so?
Think about it. You get consolidated reporting, one set of subscription documents to deal with, and you're plugging into a platform where all the governance, the banking, the compliance, it's already built and being managed by the AIFM. You don't have to go hire your own team of lawyers.
A huge cost saver. But we have to talk about the elephant in the room with any Luxembourg structure.
Yeah.
The tax benefit.
Of course. The tax framework is a major driver. When it's structured properly, the fund itself is designed to achieve tax neutrality in Luxembourg.
Meaning the fund vehicle itself doesn't add another layer of tax.
Right, the capital just flows through it. And for the international investor receiving money out of the fund,
Yeah.
this is a key attraction. In most cases, there is no Luxembourg withholding tax on distributions. That makes it incredibly efficient for pooling international capital. But, and this is a big but,
There's always a but.
The investor's ultimate tax treatment always depends on their home country and the relevant tax treaties.
Of course. So let's circle back to the AIFM for a second. We said it's the key to the whole thing. How does it actively manage risk to an institutional standard?
So under AIFMD, the manager has to run a very formal, very rigorous risk framework. It's not just ticking boxes. This means constant monitoring of leverage limits so the fund doesn't get overextended. It means having proper liquidity management tools, which is vital for these kinds of illiquid assets.
And what about valuation? With private companies, that could be more art than science.
The AIFM has to establish very detailed, documented valuation policies. And those policies are regularly reviewed by independent professionals. It keeps everything transparent. And on top of all that, you have your robust anti-money laundering and KYC checks, both when an investor comes in and on an ongoing basis. The system is built to be fast, but never reckless. So if you want to boil it all down to synthesize the appeal, what you're really looking at is a masterclass in jurisdictional efficiency. The feeder structure gives you configurability, speed, and regulatory credibility all in one package anchored in Luxembourg.
And for you, the learner, what this does is it simplifies this, this intimidating stack of acronyms. This structure is a ready-made gateway. It cuts out months of friction and lets capital get to work in these specialized private markets so much faster. It's an accelerator.
It absolutely is. It changes the whole pace of the game.
So let's leave you with a final thought on this. The fact that a fund this complex, governed by strict European rules, can be launched in 30 to 40 days. That signals a fundamental shift in capital mobility. It doesn't just benefit the investor, it actually changes how quickly deals can be financed globally. It speeds up the entire ecosystem.
That speed is its strategic superpower. But we have to end with the most important practical takeaway from all our research.
The disclaimer.
The essential disclaimer. As efficient as this is, any investor looking at this must get dedicated, professional, cross-border tax advice. We've explained the vehicle, but how it applies to you depends entirely on your own situation. Know the structure for sure, but always, always talk to your advisor before you subscribe.